Get ready, crypto fans, because the news cycle is absolutely exploding, and you need to know what's happening right now. We're diving headfirst into a whirlwind of market shifts, strategic plays, and crucial advice that could redefine your crypto journey. From massive institutional moves that are shaking up the entire ecosystem to stark warnings about market psychology, this is an episode packed with the insights you can't afford to miss. The pace is relentless, the stakes are high, and your front row seat to the future of finance starts now. Don't blink, because if you miss this, you might just miss everything. First up, we're tracking a monumental surge in institutional demand, with a major subsidiary locking down a massive $23.4 million for a dedicated Bitcoin strategy. This isn't just a number. It's a powerful signal of big money flooding into the space, and we're breaking down exactly what it means for the market and for you. Then, we're shifting gears to explore a fascinating trend: why Ethereum ETFs are not just keeping pace, but actively outperforming Bitcoin in 2025. What's driving this institutional shift, and what does it signal about the future landscape of digital assets? We've got the deep dive ready. But it's not all about the big money. We're also dissecting the intricate balance at play when it comes to Bitcoin aggregation and shareholder value. It's a delicate dance of risk and reward, and we're pulling back the curtain on the strategies and the trade-offs. And finally, a direct warning from a titan of the industry. CZ himself is sounding the alarm, cautioning against letting emotion, not logic, steer the ship through crypto's notoriously volatile roller coaster. He's sharing essential advice on navigating these wild swings and keeping your investments on track. You do not want to miss this crucial guidance. Hit that subscribe button, ring that notification bell, and let's dive in. Institutional demand surges as AMDAX subsidiary secures major funding. Massive capital inflow signals growing confidence in Bitcoin's long-term potential. A significant development in the cryptocurrency market indicates a powerful resurgence of institutional interest, with a key subsidiary of AMDAX successfully securing $23.4 million specifically earmarked for a Bitcoin strategy. This substantial influx of capital represents more than just a financial transaction. It's a clear and compelling testament to the increasing conviction among major financial players regarding Bitcoin's enduring value and its potential for significant future growth. The move underscores a broader trend of institutional adoption, where traditional finance entities are actively seeking to integrate digital assets into their investment portfolios, viewing Bitcoin not merely as a speculative asset, but as a strategic allocation for long-term wealth preservation and appreciation. The strategy behind this substantial investment is multifaceted. AMDAX, a recognized entity within the digital asset space, is leveraging this capital to pursue a robust Bitcoin accumulation strategy. This involves not only direct purchases of Bitcoin, but potentially also exploring various financial instruments and investment vehicles that provide exposure to the cryptocurrency. The aim is to capitalize on market opportunities, navigate the inherent volatility of Bitcoin, and deliver consistent returns. This strategic approach is designed to benefit from Bitcoin's projected long-term appreciation, driven by factors such as increasing adoption, its status as a digital store of value, and its potential to act as a hedge against traditional economic uncertainties. The sheer scale of the $23.4 million allocation highlights a calculated bet on Bitcoin's future, moving beyond the speculative fringes to become a cornerstone of sophisticated investment planning. This development arrives at a critical juncture for the cryptocurrency market. Following periods of intense volatility and regulatory scrutiny, the renewed interest from substantial institutional players like AMDAX's subsidiary suggests a maturing market. It signals that large financial institutions are becoming more comfortable with the regulatory landscape and are increasingly viewing Bitcoin as a legitimate asset class. This growing acceptance is crucial for the mainstream adoption of cryptocurrencies, paving the way for wider market participation and potentially greater price stability. The investment also implies a belief in the underlying technology and the disruptive potential of blockchain, further cementing Bitcoin's position as a leading digital asset. This significant capital commitment is already generating considerable buzz within the financial community. Analysts are pointing to this as a strong indicator that the market is entering a new phase of institutional-led growth. The confidence displayed by Amdex's subsidiary is likely to encourage other institutions to reevaluate their own digital asset strategies, potentially triggering a domino effect of further investment. Many see this as a validation of Bitcoin's resilience and its growing role in the global financial system. The move is being closely watched as a bellwether for future institutional engagement with cryptocurrencies, with many anticipating further large-scale allocations in the coming months. This institutional surge is a game-changer, but what happens when the spotlight shifts to other digital assets? Get ready, because we're about to explore why Ethereum ETFs are leaving Bitcoin in the dust in 2025. The institutional shift: why Ethereum ETFs outperform Bitcoin in 2025. Ethereum's growing utility and market dynamics are driving institutional preference over Bitcoin in the ETF space. The cryptocurrency landscape is witnessing a fascinating evolution, with Ethereum exchange-traded funds, ETFs, beginning to significantly outperform their Bitcoin counterparts in 2025. This trend is not merely a temporary blip, but reflects a deeper institutional shift driven by a confluence of factors including Ethereum's expanding utility, its robust ecosystem development, and evolving market perceptions. As institutions increasingly allocate capital to digital assets, the performance divergence between Bitcoin and Ethereum ETFs highlights a nuanced understanding of the underlying value propositions and future potential of these leading cryptocurrencies. One of the primary drivers behind Ethereum's outperformance is its multifaceted utility beyond just being a store of value. As the foundational layer for a vast array of decentralized applications, dApps, including DeFi decentralized finance, NFTs non-fungible tokens, and the burgeoning metaverse, Ethereum offers a compelling growth narrative. Institutions are recognizing that investing in Ethereum is akin to investing in the infrastructure of the decentralized internet, with its native token, Ether, ETH, playing a crucial role in network operations through transaction fees and staking. This inherent utility provides a tangible demand driver for ETH, which is increasingly being factored into institutional investment theses. Furthermore, the development and upcoming upgrades to the Ethereum network, such as the continued scaling solutions and improvements to its consensus mechanism, are enhancing its appeal. These advancements aim to address scalability issues, reduce transaction costs, and increase network efficiency, all of which are critical for widespread adoption and institutional comfort. The successful transition to proof-of-stake, POS, and the ongoing efforts to optimize the network have demonstrated Ethereum's capacity for innovation and adaptation, positioning it favorably for future growth. In contrast, while Bitcoin remains the premier digital store of value and a widely recognized asset, its primary utility is more singular. Institutional investors are increasingly looking for assets that offer broader applications and potential for network effects beyond simple digital gold. The narrative around Bitcoin, while strong, is largely centered on its scarcity and its role as a hedge against inflation. While this is a valuable proposition, it may not provide the same level of diversified growth potential that institutions are seeking in the current market environment. The perceived lower utility and slower pace of fundamental network upgrades for Bitcoin, compared to Ethereum's rapid development, are contributing factors to this shift in institutional preference. The performance data from 2025 clearly illustrates this trend. Reports indicate that Ethereum ETFs have seen higher inflows and greater capital appreciation compared to Bitcoin ETFs. This suggests that portfolio managers and investment strategists are actively rebalancing their digital asset allocations, tilting towards Ethereum to capture its broader utility and growth prospects. This institutional sentiment is a powerful indicator of market direction and the evolving perception of digital assets. The impact of this institutional shift is significant for the broader crypto market. It signals a maturation of the asset class, where different cryptocurrencies are being evaluated based on their unique characteristics and potential use cases. The outperformance of Ethereum ETFs could lead to increased investment in the broader Ethereum ecosystem, further fueling innovation and adoption. It also sets a precedent for how institutions might approach digital asset investments in the future, prioritizing utility and ecosystem strength alongside traditional value propositions. While institutions are diversifying their strategies, the internal health of Bitcoin itself is also a critical focus. We're now going to examine the complex relationship between Bitcoin aggregation and shareholder value, exploring the delicate balance of risk and reward. The trade-off between Bitcoin aggregation and shareholder value, a delicate balance of risk and reward. Companies strategically accumulating Bitcoin face a complex interplay between asset growth and traditional shareholder expectations. In the dynamic world of corporate finance and digital assets, companies that strategically choose to accumulate Bitcoin are navigating a complex and often precarious balance between the potential for significant asset appreciation and the traditional expectations of shareholder value. This strategic decision involves a delicate dance of risk management, financial engineering, and communication, as the volatile nature of Bitcoin can present both unprecedented opportunities and substantial challenges for maintaining consistent shareholder returns. Understanding this trade-off is crucial for investors and analysts assessing the long-term viability and success of such corporate strategies. The primary allure of Bitcoin aggregation for corporations lies in its potential as a high-growth asset and a hedge against inflation. Companies like MicroStrategy have famously integrated Bitcoin into their balance sheets, viewing it as a superior treasury reserve asset compared to traditional cash or even bonds. The rationale is that Bitcoin's fixed supply and increasing adoption as a digital store of value could lead to substantial capital gains over time, thereby enhancing overall shareholder value. This approach positions Bitcoin not just as an investment, but as a core component of a company's financial strategy aimed at outperforming traditional financial instruments in the long run. However, this strategy is inherently tied to Bitcoin's notorious volatility. A sharp downturn in Bitcoin's price can significantly impact a company's reported earnings, balance sheet health, and market capitalization, potentially leading to shareholder dissatisfaction. Unlike traditional assets, Bitcoin's price movements are influenced by a unique set of factors, including market sentiment, regulatory developments, technological advancements, and macroeconomic trends, making it challenging to predict and manage. Companies must therefore implement sophisticated risk management protocols, potentially including hedging strategies, to mitigate the downside risks associated with significant Bitcoin holdings. Furthermore, the accounting and reporting of Bitcoin holdings can also present complexities. Depending on accounting standards and regulatory guidance, unrealized gains or losses on digital assets may need to be reported differently, impacting reported profitability and potentially creating market uncertainty. Companies must be transparent and proactive in communicating their Bitcoin strategy, its performance, and the associated risks to their shareholders to maintain trust and manage expectations effectively. The question of whether Bitcoin aggregation truly enhances shareholder value is subject to ongoing debate and depends heavily on the execution of the strategy and the prevailing market conditions. For companies that have successfully navigated the volatility and benefited from Bitcoin's appreciation, the strategy has proven to be a powerful wealth generator. For others, the volatility may have led to significant paper losses, straining investor confidence. The success often hinges on the company's ability to time its acquisitions, manage its holdings prudently, and effectively communicate its long-term vision. Ultimately, the trade-off between Bitcoin aggregation and shareholder value represents a fundamental shift in how companies are approaching treasury management and investment. It requires a forward-thinking mindset that embraces new asset classes while rigorously managing the associated risks. As more companies explore this path, the lessons learned from early adopters will be critical in shaping best practices, and defining the long-term impact of digital asset integration on corporate finance and shareholder returns. Navigating these complex financial strategies requires a clear head, especially when market emotions run high. We're turning our attention now to a direct warning from CZ himself about the perils of emotion in crypto's volatile journey. Bitcoin News Today. CZ warns emotion, not logic, drives crypto's volatile roller coaster. Binance founder Changpeng Zhao advises investors to remain rational amid market fluctuations, emphasizing long-term strategy. Changpeng Zhao, the influential founder of Binance, has issued a critical warning to cryptocurrency investors, urging them to resist the urge to panic sell during periods of market downturns. In a recent communication, Zhao emphasized that emotional decision-making, particularly fear-driven selling, is a primary catalyst for significant losses in the highly volatile crypto space. His timely advice comes as the broader cryptocurrency market experiences a notable dip, with the total market capitalization falling by 3.22% to approximately $3.76 trillion. Major digital assets have seen declines, with Bitcoin, BTC, down 3.49% to $108,542, and Ethereum, ETH, down 2.94% to $4,351 over the past 24 hours, reflecting a neutral sentiment indicated by the current fear and greed index reading of 47. Zhao's core message centers on the inherent cyclical nature of the cryptocurrency market and the psychological pitfalls that often trap unwary investors. He argues that selling assets during a dip is typically a reactive measure that can lead investors to miss out on subsequent recovery phases and potential gains. This perspective advocates for a disciplined, long-term investment strategy, encouraging traders to maintain a strategic holding pattern rather than succumbing to short-term price fluctuations. This approach is particularly relevant in the current market climate, where investor sentiment is balanced between caution and optimism, making rational decision-making paramount. The Binance founder's commentary also touches upon the broader phenomenon of investor psychology in crypto, where emotions like FOMO, fear of missing out, and panic selling often dictate market movements. Historically, rapid price increases have triggered FOMO, leading to speculative buying, while price drops often induce panic selling. Zhao's guidance aims to equip investors with a more rational framework, promoting strategic thinking over impulsive actions, especially within a market known for its emotional volatility. This emphasis on logic over emotion is a cornerstone of sustainable investing in any market, but it is especially critical in the fast-paced and often unpredictable cryptocurrency environment. Adding to his insights, Zhao has expressed a strongly bullish outlook on Bitcoin's future. During a recent appearance at the Bitcoin conference in Hong Kong, he projected that Bitcoin could potentially reach between $500,000 and $1 million within the current market cycle. He further elaborated on Bitcoin's potential to eventually supplant the US dollar as a global reserve currency, a bold prediction that underscores growing confidence in Bitcoin's long-term value proposition. This optimistic forecast is bolstered by the increasing integration of Bitcoin into mainstream financial systems and the growing interest from sovereign nations in exploring alternatives to the US dollar. Zhao also highlighted the increasing influence of institutional adoption on the cryptocurrency market. He pointed to the significant investments being made by treasury companies and major firms like MicroStrategy and BitMine in Bitcoin and Ethereum. These institutional strategies are not only driving demand, but also shaping market dynamics, moving the focus from retail speculation towards more strategic, large-scale investment. Zhao stressed the importance for individual investors to recognize and adapt to this evolving landscape, where institutional activity plays an increasingly dominant role. The overarching implication of Zhao's message is the necessity for a mature and strategic approach to cryptocurrency investing. By advocating for discipline, long-term vision, and an understanding of institutional flows, he is guiding investors toward more resilient and potentially more profitable strategies in a market that continues to mature and integrate into the global financial infrastructure. This expert advice is invaluable for navigating the market, but how does it all tie together with the big picture trends? Stay with us as we bring our incredible episode to a close with a rapid-fire recap of all today's top stories. And that's a wrap on another action-packed Bitcoin bulletin. We saw institutional demand surge with AMDAX locking in $23.4 million for Bitcoin, explored why Ethereum ETFs are outperforming Bitcoin in 2025, dissected the delicate balance of Bitcoin aggregation and shareholder value, and heard CZ's crucial warning against emotional trading. Don't miss out on any of the breaking news. Make sure to hit that like button, subscribe to the channel, ring the notification bell so you never miss an update, and follow us on all social media platforms for more insights. We'll see you in the next one.